disqualified. I would like to ask the public to turn off the ringing of their cell phone. I will now invite the judges to introduce themselves.
So Maxime Caron from Itachi Capital. I'm working in the Treasury and Pricing department.
Pascal, I'm working as a valuation advisor in private equity infrastructure for a CND.
Professor in finance in
So when you're ready.
Capital is flowing into the alternative investment class faster than ever. And with that comes an added responsibility to scrutinize investments. And that's exactly why we're here today. We're here to tell you whether EasyRent is an opportunity or a pitfall. Today, I'm here with my colleagues Augustine and Faris. My name is Ivar, and we are IFA Financial. So let's take a look at what we're here to do today. We're going to evaluate EasyRent based on comparables, to establish an optimal governance structure, and thirdly, to provide a portfolio complementing the acquisition of EasyRent. So let's take a look at the overall situation and take a step back. So EasyRent wanted to IPO on the Toronto Stock Exchange. However, that they did not succeed in. So now there's an opportunity for WeBuy to acquire EasyRent. Now, let's also take a look at EasyRent overall. What is their business? What do they do? And how can you capitalize on that? So the business model really is entering long-term leases with property holders, and then divide the spaces into smaller portions and sublease that to other short-term leaseholders, much like the company WeWork that you might be familiar with. So the target market really is entrepreneurs, startups, and professional service companies. Now, they have some differentiating factors such as modern workplaces, competitive costs, and fostering innovation. And fostering innovation really comes through bringing different companies together that are like-minded, and that really brings more growth in their own businesses. However, there are also some issues. So we're looking at CEO entrenchment, we're looking at excess leverage, and we're also looking at a company that only became profitable in 2019. So that's something that's also really crucial to take into consideration. So overall, the company really has a strong value proposition. There are some issues that has led to the loss of investor confidence, and that relates to the failure of the IPO. And something that also you should take into consideration when you're evaluating this. So we also take a look at the competition. So we can see that EasyRent, it is the largest in its size and the best service offering. So you can see that BestRent has comparable services, but they have lower quality. They're only using buildings that are 20 years older or more. You have Office Hub. They focus only on small to medium enterprises, which is good because they have a narrow focus, but it doesn't allow them to have the scale that you have, that EasyRent has. You also have Like Home that targets self-employed workers, so more narrow market. And Community also has a narrow focus, which leads to having a low growth, not being as competitive. So the takeaway here is that EasyRent dominates the market through its high quality offering and scale advantage. So really allowing them to adjust their offering whenever there are new opportunities and new leaseholders that are coming in. So firstly, we'd like to show you an evaluation of EasyRent, and I'll hand it over to my colleague, Augustine, to take care of this portion.
Thank you very much, Ivar. So as investors, how do we evaluate different investment alternatives? Part of it is we use valuation multiples, which I'm going to be walking you through today. So the market cap, as we can see, first of EasyRent is the highest among its peers. And when we look at the price to earnings ratio, this is a great ratio to use when you quickly want to see how much investors are pricing its earnings into the future. So the price earnings ratio is divided by the price per share, or the price per share divided by the EPS, earnings per share. And it's an easy ratio to use off the cuff on the back of a napkin, and it shows how much investors are willing to pay now for $1 of earnings in the future. Con of this ratio, using this ratio, is that earnings can be manipulated throughout the income statement, so you want to use other financial metrics in addition to this one. And a high or low price earnings multiple is not always a definitive decision on if this is a good or bad investment. You can't just say this is a high PE, bad investment, because it can continue to work against you. So next we look at EV to EBITDA. So to compute this, we have to find the enterprise value of the company, which is the equity value plus the debt minus the cash to arrive at our enterprise value, and we divide that by the company's EBITDA. So again, this is an easy ratio to use. A lot of investors look at it, and allows investors to compare across multiple sectors and companies. So you can use this multiple to compare against industrials or technology companies or materials or consumer staples, anything like that. And it's applicable to all stakeholders in the business. So one of the cons is it can show an overly favorable number as CapEx is not included and can be huge for the company. Again, and also EBITDA is not always the best proxy for cash flow and earnings, and it can be manipulated throughout the income statement. Next is the price to sales ratio. So this is a convenient multiple to use when the company does not have earnings, but you want to see how much investors are paying for how much revenue it's bringing in. So this will be the sales divided by the shares outstanding, and you'll find the price to sales ratio here. This is convenient, of course, when they have negative earnings. And a con is it doesn't account for what happens below the line. So it could have a terrible capital structure. It could be not making any net margin. But using this ratio, you can kind of see how smaller startup or tech firms can be valued using this ratio as well. So next we go to book value per share, and this book value is the shareholders' equity that's found on the balance sheet. And so we take the book value and divide it by the number of shares outstanding, and we find the book value per share. So again, this is easy to calculate. It takes account into all the capital that's in the business for shareholders, owned by shareholders. But a con of using this ratio is that companies can have large portions of their value in intangibles, and it's not always actively marked to market. So if it's on the company's balance sheet, it's at historical cost of the company and not marked to market. So you want to be careful using this metric as well. Now we wanted to look at net debt to EBITDA. So this shows how your company, the liquidity position of your company, and how easy is it for you to pay off your debt, given that you operate at the same income level. So this is financial net debt to EBITDA, and it can be misleading if operating capital leases are not taken into account. And these are the operating leases for the company. So this will, EasyRent is in a good position at 0.3 times net debt to EBITDA financially with their financial ratios. So basically, to find a value per share, we did a rough discounted cash flow analysis. So I assumed revenue growth of 10%, which is a little bit lower than the guidance by the company, which was 15% year over year. We just think that 10% is a little bit more conservative and a little more attainable. And then we assumed 5-year 100 bips expansion of operating margin. This is due to cost cutting that we'll talk about later in our presentation with management and operational efficiencies. And then I assumed an exit multiple of 6 times, when it's trading about 5 to 5.5 right now. So evaluation summary for EasyRent, the relatively stable low multiple is a PE of 7 times and EV/EBITDA of 5 for this business. Its financial net debt to EBITDA is not too high, and we're paying for higher than average operating net income and EBITDA margins with competitive prices and the size advantage of the company. So now I'm going to give it off to Ferris to talk about the operational challenges of the company.
Thank you, Augustine. And now let's look at the corporate governance, since it's one of the main essential elements in assuring the future performance of the company. If you look at the ownership structure, as we only focus at the Class A split, we can see that the main block holders here are Matthew and SoftBank, mainly institutional investors. Yet, what clearly is clear here is the shares classes between Class A and Class B. We can see that there's a 95 million in Class A and 10 million in Class B. And if we take the market assumption of 10 to 1 of Class B voting power, here we can see that the CEO, Mr. Matthew, has around 56% control over the board. And this is very crucial here to identify, since this clearly shows that the CEO has full control over the board and has a negative impact on the performance of the company. If we look at the current board composition as well, we can see that there are 4 directors, which are Matthew, Wayne, Marcus, and Sarah. And here we see that there's a conflict of interest between Matthew, Marcus, and Sarah, because they all have worked together, which does not align the best interest of the company with the shareholders, as well as maximizing the future value of the company. The key takeaway here is that board lacks independence and business acumen. So the key issues with governance that we have spotted. What are the issues that are going to prevent, let's say, the performance of the company? We have highlighted 2 main issues. One is the misallocation of resources, which was clearly identified through the private jet that was personally used for the CEO. This clearly shows that the company is not being able to allocate the resources it has into the best optimal way in order to achieve future performance and to capitalize on the growth in this industry. The second point is the compensation misalignment. We see when looking at the income statement that the expense of the company is high for governance is highest among the investors, which clearly highlights that the company needs to have an overall restructuring of its governance. Now, the key takeaway here is that the board of directors must drastically restructure to maximize company value. What are the recommendations here? We have identified 3. One is to fire the CEO, CFO, and SARA from the company. Number 2 is to create and establish an option compensation structure for the directors in order to align their interests with the best interests of the overall company and not only with the shareholders. The third one is the overhaul of the board structure. Now, let's dig deeper. Number 1 is optimizing the board members. What is it? Out ineffective members of the company. How will we do it? With a golden parachute, which is technically compensating the directors to leave the company. The impact of that is aligning the incentive of management with the company, and that's what we are trying to achieve. Moving on to the second strategy, which is the option. How would that be? For a blended compensation for the key members of the company with the base salary and performance-based option. How would that be? 2 years exercisable options of consistent performance, which is going to assure that the board, that the members within the company are going to align their incentives with management. So overall, we're going to eliminate Class B shares in order to have a even voting structure for better business decisions and performance. Number 2, integrate 2 We Buy members of the PE firm on the board of directors in order to ensure stable and aligned opportunities within the company. And third of all, assign an independent director that has a well-known track record in order to shift the company and allocate the investment of the company for its full potential. So if we look at the timeline, how would that be done? We're going to start currently, just as now, with firing underperforming members, as well for eliminating Class B shares. And then 2 years or one year half in advance, we're going to put the We Buy members on the board, as well for eliminating Class B. Okay, so sorry for that. Year 3, we're going to implement an option compensation strategy. And now I'll pass it to Ivar to tell us more about portfolio construction.
So one of the challenges or mandates that you gave us here today was to identify which complementing investments you could have in combination with acquiring EasyRent. So what's really crucial to take into consideration is that, well, if we might acquire EasyRent, you have an asset that has specific characteristics. You have a reliance on companies coming in, you have a reliance on an 85% occupancy rate, and other factors that really make this somewhat of a risky investment. So you and I identified that we have identified that we have a money market instrument which has low risk in return characteristics. It ensures liquidity and has a 3-year investment horizon. And what's really important to take when we're establishing a new type of investment is that you still want those characteristics. However, you might want to bump up your return in order to really capitalize on the money you have. You don't want to leave it in a money market instrument because that's not going to give you more returns. And the returns eventually is what compensates both the people that invest in you, the limited partners, as well as yourself, seeing that you'll have a hurdle rate and other private equity compensation structures. So looking at the investment portfolio, we're really looking at having AAA corporate bonds and investing into debt instead of investing into the money markets. And we see that this is going to have a higher yield while maintaining those same characteristics. So what we really looked at was that Moody's corporate bond yield was 3% in 2019 versus 1% in the money markets. So that 2% bump is something that will really give you more money and in turn give you, the investors, more money, allowing you to have a better product to sell when you go to these limited partners. Secondly, the corporate bond market is about 8.8 trillion, so you'll have that same liquidity. You don't need to go to the money market in order to have the liquidity that a private equity firm needs in order to maintain the operations, in order to maybe have additional cash flow to your holding companies. So that's another thing that we really felt was really pertinent when it came to choosing this type of investment. And it also allows investors to take part in the prosperity of other high quality companies. So that's something that came into our minds when we looked at, do you want to have money in the money markets, or do you want to be able to take part in other companies, feel their success, and really be able to evaluate them as part of your overall portfolio? So to conclude, we really looked at evaluating EasyRent based on the comparables. So what that came through was that we looked at the different comparables, and as my colleague obviously mentioned, you can't just look at one of them in order to evaluate the entire company. You have to take the holistic picture and make sure that you're making the right decision. So we came to the conclusion that you'll have a higher return as the target price was above the $20. Additionally, establishing the optimal governance structure. So there was a really large issue in the company, EasyRent, where you have no independence in the board. You have members of the board that are the spouses of the CEO. You have large entrenchment with over 56% holding of the sole CEO, who's the director and also the chairman of the board. So what we really came down to here was to eliminate those members of the board. And what's a key question is really that how would you house them? How can you make sure that they're going to leave the board and make sure that your company is going to be able to put in your own directors to generate a return over that 5 to 7 year holding period that we have assumed. So really we looked at the case study of WeWork and said that, okay, well, what did they do? They offered a gold parachute. It was over $1 billion, so we're looking at a lower sum here. But we still think that in our evaluation, it will still give you a positive return over that overall holding period. And also restructure the overall board will allow you to make operations much more efficient. And it does allow you to also have more control over what the actual board is by having your own members there. And thirdly, providing a portfolio complementing the acquisition, really taking the money out of money market, which is a low return, but it still has those characteristics. So we're going to maintain the liquidity characteristics and also the low risk, but just bumping up that return slightly to make sure that you have a spread between the capital you're getting in and to make sure that you have a really good product to sell to the limited partners that you're going to be approaching. So that's it for today. I'd like to thank you for your time and open the floor to any questions you may have.
The initial idea was to finance the Asian expansion. So as a potential new shareholder, how do you think this growth plan is, what's your view on this growth plan?
Well, really, we believe that you should first take the company as it is and restructure it. You shouldn't expand to a new continent if you don't have the operations in the current geographic area up to par. So that's why we recommend really taking that expansion and postponing it, and then just focusing on your company now. Of course, the next step would be to do that expansion and maintain that market leader position and really expanding that globally.
The numbers looks good. You are at the $25 price per share. What are the risks for us as an investor to invest in this company? Is there something to expect that could we lose some of our investment? Is it risky or not?
Yes, we really think the risk arises from the asset liability matching that you'll be needing to do. So when you're taking on these long-term leases and leasing them at shorter terms, you really have a discrepancy between the inflows and the outflows. So you have these large mandates and these large liabilities that you'll have to pay, sometimes being billions of dollars, as you indicated to us. And we think that if you don't have the surety of the cash flows coming in, that poses a large risk on your company. So really that's why it's important to have those operations optimized locally before you go globally, because if you just scale up, you're going to have a mountain of liabilities and cash flows that are extremely uncertain. That would be too much of a risk to put on your firm and also your investors.
For recommendation, you will be talking about firing the CEO, CFO, and Sarah, the CEO wife. Do you think is it easy, and do you think is it appropriate to fire these people who built this company and they have a lot of knowledge, experience? That can be,
It's certainly a good question, and thank you for asking it. Number one, if we look at the board composition, we see that the board is not independent, and that's a huge concern because this means that the performance of the company, there's a conflict of interest in that. If we're looking at firing the CEO and the CFO, this is going to be through a compensation package. Certainly it's going to cost the firm money, yet it's in the best interest of assuring that the value of the company is going to expand over the long term and through maintaining this performance. There's certainly an important element in keeping these members because they hold a great history, but the future, what the future holds, is by eliminating these members and getting new members and new bloods into the company in order to assure that it succeeds and achieves its growth prospects, especially because a lot of companies, if you look at the model, are adopting the strategy of reducing their assets on the balance sheet through eliminating their expenditures of P&E and investing in CapEx. That's why this company holds great potential, and through a good corporate governance structure, we believe that this is going to be achieved.
What do you guys think about the recent change in the business model, so to provide longer-term contract to well-established clients in terms of risk and return?
Yeah, I think one of the dangers of investing in a company like this is the short-term leases. You don't know, how the companies that lease out these spaces, how they're going to perform financially, if they're going to be your tenants, in 360 days from now. So you want to kind of eliminate that uncertainty and work with companies that have a proven track record, have a plan for growth, are willing to sign with you for the long term, so you can lock in those recurring payments and provide stability over the business cycle. So whatever company comes in, you know that they're there for the long run, and you have stable cash flows that you can look forward to over time.